like that you're eating beef.
You're still on your carnivore diet?
Oh, dude, I'll never eat a plant again.
Interesting.
No way.
How's your blood pressure, all your vitals and everything?
I don't care about blood pressure. I am never going to allow an average to compare against my vital signs. Like to go to a doctor,
good, right? You feel great.
Yeah. Like, I don't
you
care
look
about
great. You look like you're doing everything right. So I gotta probably get on that bandwagon here.
Well, I mean, once you, I mean, because the part of the reason I became aware of this is I was shocked at the amount of military retirees we were having with sleep apnea. And when you think about,
it's like 1 in 2.
Yeah, it was getting kind of crazy. I'm like, wait a minute, this is our the best healthiest Americans out there, and I realized, it's just a function of the VA disability. Let's get them going through just check boxes, and sure they have sleep apnea, but these are reversible things, and knowing that the benefit on the VA disability isn't that much better versus how much it can actually cost you on the insurance side of things. And so that's, we think about cost of life insurance. A good caveat into what we're talking about is, how do you reduce cost? Get healthier, and reduce the rate. So, short story on my diet thing. I realized, hey, one of the ways to do that is kind of an elimination diet. You detox and you can fix all sorts of stuff. One of them happens to be sleep apnea, but so clearly when we think about VA disability, getting things on your medical records, to improve your VA disability rating, recognizing that as a military retiree, especially if you're in the senior ranks that are getting a pretty good job in post-military, is that extra $1,000 a month for VA disability worth it? Especially the hassle of going through the process compared to what it's going to cost you on just life insurance costs on the outside, let alone having to wear masks and stuff and take medications and going back for follow-ups. So there's other aspects of costs, time, stress that go into it, especially when making the survivor benefit plan decision, any financial decision. What do I do with my thrift savings plan? How do I understand life insurance and what's this going to cost me to go into it? How much stress how long is it going to take? So that's what we do at US Vet Wealth. And let me show you my screen real quick, just to show you kind of where we're going with things. Is to make that first part of all that easier, just to get the stress as you're going through retirement. Maybe you're already, into post-military life and you're questioning, did I make the right decisions about thrift savings plan? Do I have an option here with the SPP? Do I need to rethink my life insurance strategy? The first thing we need to do is an appraisal of your military pay and benefits. So if you go to our website at the top, and we're going to have other ways to access this, is to get to our appraisal page. I got a number of videos here that explains, why you need to do an appraisal of your military pay and benefits. So you see what you get, so you see what you're worth. We go through a full case study with Mike Wallace from Blue Water Advisors, asking great questions, kind of sitting in your seat as a retiree. And then whenever you're ready, you can go ahead and schedule the appraisal with us. Just let us know kind of what the main topic you'd like to talk with us about. And this will get you on the calendar with either myself or Trevor on our team. And we talk a little bit more about your situation. And if you're a good fit for the War Chest strategy, then you get on a call with Mike. And so why we do these webinars with Mike here is so you get a little bit of a peek inside the process on, what is this insurance strategy? What does this War Chest look for me? What is Index Universal Life Insurance? What are the costs? How is this different than traditional life insurance? So that's what we want to talk about today is look at the actual tangible cost, because the cool thing about this with life insurance, it's a contract. You can literally see the costs versus just this vague 1% of whatever the value is going to be. Or think about when you're buying a home or a mortgage. Do you know what you're paying the title person and what it's complicated to see where the costs are. So that's what's so great about this strategy. You can see it and you can ask the questions right there, what it is. So Mike, I'll pass it over to you. Any other context you want to hit on before we dive into some numbers?
Yeah, no, I appreciate that, Scott. And thanks for everyone for joining. So, we have a thing we say at US Vet Wealth, and you'll see it on our materials and our website. Your health is your wealth. Your health is what does that mean? That is, well, that's not a new phrase everyone's familiar with. a wealthy life is a healthy life. But a way we look at it is right at that transition period, call it 2 years prior to right at day one, is generally when the folks that we work with are in their healthiest. They're right there. And then what we've seen is a couple of years post-service, maybe they're not as healthy. Maybe they're not training as hard as they did when they were in service. Maybe they're working this new job and they're figuring that stuff out and moving around and PCSing. And so what we're sharing is the nice thing is the earlier, the better. And so we get qualifications, we get everything kind of in place within that 2-year window prior to transition when you're at your healthiest. Because as we get older, of course, it doesn't get better generally. But what we like is we lock it in now and then we're done. And then we know we've got this protection. We've got the lowest possible rates indefinitely. So that's health is your wealth is the takeaway from today's call for sure.
Oops, sorry, I was muted there.
Yeah.
Great. So obviously the easiest way to reduce life insurance costs is from having better health, but can't always control that when you need to apply for life insurance. First, we're just trying to get you qualified at the best rates. There are opportunities to get qualified again at a better rate down the road. But then the other way, well, how can we manage the costs? Well, one, we're managing taxes. That's a huge cost. So taking that off the table, managing the cost of losing money in the stock market, if we can avoiding that cost. But then when you're putting money into an insurance policy, where does the dollar go? How is it actually benefiting you and essentially the insurance company? Because they have to make money to make this all work out. So Mike, I think that's what we want to show today.
Yeah.
Is just run through an example of the actual charges. What makes this
I'd love to
work?
I'd love to, and thanks. So a lot of folks have heard, life insurance is too expensive. Life insurance, the costs are too high. And that's such a broad statement and very miscategorizes how this industry works. It can be expensive if it's not designed properly. So with the US Vet Wealth and in our war chest strategies, we focus on cost first and foremost. When someone speaks with me, and I've spoken to many of you on this call today, what do we talk about? We talk about expenses or something we can control. And we also talk about, structuring the policy appropriately to minimize those expenses. So what does that mean? That really means the cost of any life insurance, term life, whole life, this IUL war chest strategy, the cost is in the death benefit. And this is not a good, bad, right, wrong thing. It's just that's how it works. More death benefit, more cost, less death benefit, less cost. So then we ask ourselves, what's our objective here? Our objective, and I see it as twofold. One, we got to protect the family. We got to protect the family. We're just getting out. We're 47 years old. We've got a pension of 130. We're taking another job, making 125. We're $250,000 a year of income. We got a young family. We got to make sure, God forbid, something happens, the family's protected. That's death benefit. Guess what? Term insurance. Term insurance is cheap. $1 million costs you a few $100 a year. So we supplement the strategy with term insurance because we're doing it to keep the cost as low as possible. On the permanent insurance side, the IUL side, the war chest side, again, the death benefit is the cost. So we buy as little death benefit as we have to there based on funding. And people say, well, Mike, why wouldn't I buy as much as I have to? Why buy as little as I can? The answer, again, cost, right? So and again, several folks that I've worked with, I'm sure that are on this call or watching this video have seen it. We generally have a combo deal, an offensive defensive deal where we get the term insurance for a 15, 20-year period through retirement, if you will, through kids are gone and family need protection is less. And we do that inexpensively, a couple $100 a month. Then we have the permanent insurance growing over time so that when we get closer to life expectancy, we kind of target that $1 million roughly bogey. And the reason we do it that way, the reason we separate or bifurcate the death benefit from the cash, the IUL, the war chest, is, again, we're trying to keep the cost low. So that's kind of how we design these things. I think that's meaningful. I'm going to share an illustration. And when I go through the illustrations with many of you, I've gone right to that cost, a charge report, the expenses. And I lean into that. I want you, first of all, eyes wide open. Everyone that knows me, I lean into education, learning, making sure this is a comfortable decision for you and your family. The cost of the insurance is meaningful. So what I'm going to show you, I think, is probably going to be surprising because I'm going to show you the cost of a policy we're working on right now for one of our clients and how those costs work. And over time, you'll see that the costs are extremely low. So I'll go ahead and share that now.
Awesome. Let's do it. Client of ours watching over on YouTube.
Very good. All righty. Scott, you see my screen there?
Yes, sir.
Very good. So this is a great story for those that haven't been familiar. This individual is Scott's first, or one of his first clients, almost 15 years ago now. And she was in the military, still is. She's transitioning out in the first of the year. And she did her 22 years, I believe, is how long she did service for. And Scott provided an IUL solution, a war chest solution for her 12, 15 years ago. And she's stayed in that path. And guess what? It's worked out tremendously. She's gained almost $100,000 in cash value in the policy. And now she's at transition. And at transition, she's got her pension. And that's about 100 and a quarter. And then she's going to have a secondary income in the private sector, about another 100 and a quarter. So as she's been happy and seen the success of this IUL strategy, we had a conversation with them, speaking with her the last few months. And we say, hey, let's move this product, move this cash over. It's called a 1035 exchange. Move the cash from one policy to a new policy that wasn't available 10 years ago, but it's more efficient today. And then she said, guys, I want to take half my income. I want to take the 100 grand I'm getting out of my private sector job. I want to live in my pension. I got plenty of income there. And just for 5 years, put it in this policy. And for those of you that are unfamiliar, one of the variables, one of the factors that determine the success here is funding early and often. It's much more efficient to get the dollars in the policy in the first 10 years than over 30 years. And again, everyone that I've spoken to has seen that information. So this is what we're doing for her. So if you look at my screen here, on the left-hand side of the screen, this premium outlay, that's the amount of dollars we're putting in the policy. She has $96,852 in her old policy in cash value, and we're putting $100,000 in for 5 years. At 52 years old, she's done. She has $600,000 in premium that has gone into the policy. She's done funding her policy. And then we'll look at the numbers in the future and what that looks like for her. But that's kind of where we are. So what we're here to talk about is the policy expenses. Again, how much are they and where are they? So there's 3 primary expenses related to life insurance. First one's a premium charge. What is that? That is 5.5% of every dollar we pay in premium with this particular company and carrier. And that's right within industry standards. Everyone's kind of within that 5 to 8 ballpark, but 5.5%. When we're done paying premiums, that goes away. It's not existing anymore. I'm going to skip over the COI for a second. The second charge is this policy issue charge. And that is a 10-year charge. And then that goes to 0. And that covers the cost of delivering and issuing the policy. It's the U.S. Vet Wealth compensation. It's the insurance company compensation. Everyone takes a piece of that. Again, after the 10th year, that goes away as well. So as I stated earlier, during the first 10 years are when most of the charges are born, and then the policy gets efficient. So now we're in year 11. The third cost is the COI. That's the cost of providing that death benefit protection. And that grows over time. Makes sense. We're putting money in, the death benefit's going up, she's getting older. And then you'll notice right here, in year 7, the death benefit, the cost of insurance is $2,100. And then it drops to $450. So people say, well, what happened there? Why did it go down by 75%? If you look on the right-hand side of the screen, one of the features, the flexibility we like within this policy is the option to reduce the death benefit. Why would I want to do that? Because I want the cash to grow more quickly. The one way we know how to do that is to keep the cost low, the cost in the death benefit, once again. So you'll see that, and this individual, she's like, Mike, $1 million is plenty. I don't need $2.5 million. So we bought as little death benefit as we had to at $2,057,000. It grows to 2.5. And then I chopped it down to $1 million because that's what she said she needed. And so by doing that, the cost of insurance went from $2,000 to $450. And then there's this little $60 charge for making that adjustment. And there's a $5 ongoing monthly admin fee. But those are the charges. So premium charge, while we're paying premiums, policy issue charge, 10 years and goes away. And then the COIs, which we can manage. So as I mentioned earlier, year 11 is the magic year. Year 11, a couple of things happen. The policy issue charges are gone, so that's gone. The COIs now are reasonable, $500, $600 a year. We got a little $5 admin fee. That's it. That is it. That's, if you look at the percentage of where that does, that's less than 1/10 of 1%. Here's the better news. You see this bonus interest credit column. What is that? This is a mutual insurance company, meaning it's owned by the policyholders. As a policyholder, owner of the company, they start rebating, paying you back some of the fees you paid in those first 10 years, beginning in year 11. It's contractual. It's built into the contract. So because of this, the way this policy was funded, very richly funded over a 5-year period and done, the bonus is substantial because that's what drives the bonus, is how well it's funded. So in this case, the first year bonus interest credit for this client, $4,800. That's a bonus. That's not in parentheses. That's a positive adjustment to her values. And if you'll look at this comparably, what's the cost? Well, the cost is $604 plus $660, $664 in expenses against a bonus credit of $4,800. So the bonus is greater than the expenses. That's meaningful. And this isn't even what this individual has earned in interest credits and growth. She's actually earned this year alone $40,000 there. So that's what she's made in growth that's the interest credits. That's the growth on the contract. This is just the bonus. And then we carry it forward as we get older, the bonus continues to grow, as does the cost of insurance. Now it's around $2,000 as we get older, because COIs get higher. But then the bonus keeps going up as well. And then you'll kind of notice the COI is kind of leveling out here because the cash is growing. The cash is growing more substantially. And then as we get older, the cost of insurance gets higher. Guess what? That bonus is still greater. And then throughout life expectancy, then when you get to 95, the policy endows. There is no more cost of insurance. The bonus is still being paid. So the story is, going back up here to the first page, during the first 10 years, most of the costs are borne. How do I reduce my cost? One way is design it properly. And that's what we do. Little death benefit based on cash. The second is fund it well. If we want to put dollars in, we get it in as quickly as possible. That produces a higher bonus, and it also provides additional benefits. So this is how we adjust the cost. If you do the math here over a 20-year period, so the first 10 years, it's around 3%. The next 10 years, it's less than 1%. We're at about a 1% cost all in on this policy, less than 1% over the long term. And if the investment mutual fund's about 1% as well. So about the same as a mutual fund, but what do you get? Life insurance, death benefit protection, tax-free, zero downside, all the things we love about it. The last thing I just want to touch on quickly, Scott, if we could, is showing what we're doing with this policy for her. So she wants to retire at 60. She's put in this $600,000. She wants to retire at 60. We were going to pull income tax-free out of this policy for her at $76,000 a year for the rest of her life. So I think until age 90 for 30 years. So now she's using this as an additional income stream in retirement, $76,000 a year. So just looking at the bottom line, she put $596 in the policy. She's taken $2.3 million out in tax-free income through age 90. And there's still now $500,000 in death benefit going to her family. So this is how we use the policy for her. But again, all that is possible by designing it properly and keeping the cost low.
And, one way to think about, those initial years, because that's, traditionally when you hear about, life insurance as a place to put money in the financial planning world, they're comparing it against a traditional mutual fund. So yes, on average, it's close to 1%. I actually think we're being generous there. I think it does a lot less than 1%, but especially designed properly and used properly. But those initial years, another way to think about it is that's what the insurance company's on the hook for. That's really, they want to know that commitment. That's part of the rebate offer, is that, once you're in the policy for 10 years, excuse the construction that's behind my house, building a bridge nearby. But if, the idea with that 10-year, that's kind of the buy-in period. Like, hey, we're in this together, mutual company, we're in a contract. It's not, we're investing your money on your behalf. I mean, yeah, there's part of that as part of the contract. There's money management, but that's not the only value add. So a lot more moving parts. Again, kind of like real estate and a mortgage. Those first years, you got to pay more of the interest up front, before the equity builds. The good thing is this policy, the costs don't eat away nearly as much in a traditional long-term investment or even a traditional long-term life insurance policy. With whole life, you got to wait more time to get the equity. But with the IUL, not just the IUL, the uncapped IUL designed the way we design it is what gives us the ability for early liquidity. That's why it only works. I just got off a call with a client who's said they were talking to a financial professional who was really working with trying to get new young people entering the military into the IUL so they can put a couple $100 a month away. It's like, I mean, put it in a Roth, put it in an IUL, whatever. It's not going to move the needle one way or the other. You got to learn how to really make more income. So the idea with the IUL, really, we're talking $1,000, $2,000 a month, or bigger lump sums, is when this becomes more attractive. And so obviously, as a military retiree, getting extra pension, maybe you don't need to take as much risk. Maybe the idea of cost with your money changes a little bit. You can think about like, oh, maybe there's a trade-off here to get me more peace of mind, more protection for my dollars. So understanding the full context of how these works is very important. We go over this obviously in detail one-on-one with anybody who wants to work with us in figuring out what this would look like for their numbers. But again, let me just show this real quick. The idea that we're talking about today on the offensive side of things, the on the term, if we're just being straight defensive, the cost is in the amount of death benefit that we're purchasing, what your health is. But on the IUL, we're designing it to keep costs low so we can increase the cash equity because we don't think you're going to die. Yes, we know you're going to die eventually. It's permanent life insurance. There's going to be a death benefit. That's part of the strategy. But really, we're taking advantage of the tax-free growth and giving you access to that money when you want to use it. So that the example we showed, someone who's able to put in $100,000 a year for a few years could put it in longer too. It doesn't have to stop at 5 years. But that's possible. You're making dual income. If you don't need to use it, if you can sock it away somewhere that one is tax-free and you can turn around and access it, but then to see right there, those are the costs. Those are the charges that are going to be involved, but you can see exactly how it's going to play out each and every year, and the ability to adjust it as you go is important as well. Let's see, I got one other comment here. Okay, cool. Awesome. Well, I think that was hit our main points for today. Mike, anything else you want to
Yeah, no, I appreciate it. I think, like I mentioned earlier, I love sharing this story. I love focusing on these things. This is what I do. Every case is different, and every individual scenario is different, of course. So those one-on-one calls are meaningful. So once you determine if this is something you'd like to learn more about, if this is a strategy you'd like to see if it makes sense for you and your family, then that's the conversation I'm looking forward to have with you. I'm going to touch lastly, just to make sure we understand why we're doing the term insurance again, because that's meaningful. And I want to talk about that again. The term insurance, the reason we design the policies and have term and permanent, have the term and the offensive IUL, is that is in the consumer, that's in the insurer, the client's best interest. And I think it's meaningful to say there are other agents out there that will say, you need $1 million in insurance, we're going to do $1 million IUL, you fund it with whatever you can and hope for the best. This is not what we do. And quite frankly, $1 million policy, as you guys can imagine, pays us more. But guess what? It's not in the client's best interest. So every decision we make is that's first and foremost. That's what we do. We lean into that. And this is another example of it. The reason we separate or bifurcate the term and the death benefit part, which is just, commodity, exactly as Scott said, and the cash side, we want the cash to grow. And that's why we design it that way. So again, anyone, happy to have those conversations with you.
Awesome. Well, again, to do that, go to our website, click the free appraisal button. That gets you on a call with us. We'll crunch numbers with you. No cost. This is, again, our way of, we know military retirees need to make these decisions. They often have to do it in a short time frame, and then they're thinking they got to go and learn all this new information. And we've already done that research for you. You can watch our videos, read our books, but we can help you make the critical decision a lot quicker. I mean, literally in 10, 15, 30 minutes max by just crunching the numbers. Then you can move on. So that's why we give this away for free. Obviously, If you're a good fit to work with us, we'll let you know. We'll point out some things. If you're interested, you're going to be looking through our stuff anyways. So when there's a good fit, we let you know. If there's not, we'll let you know as well, because it might be a couple years down the road. But if there's a health issue or an income, if we don't have the quite income in yet, but we can talk about all those things. So if you need to solve these problems, this is what we do. This is all we do, working with military retirees, and look forward to seeing how we can help you.
Absolutely. Thanks, Scott.
That's all for now. All right, Mike. Thank you.